So today I wanted to talk about one of the significant announcements that came out this week. And no, it's not the election result. It's actually the announcement by APRA, which is the Australian Prudential Regulatory Authority, that banks can actually set their own assessment rate. So currently the assessment rate is set at 7%, but APRA has now revisited that and decided that banks can use their own discretion. So, 7%, why was it set at 7%? It was done predominantly as a buffer on the basis that at some point interest rates would go up, and obviously lenders need to make sure that they stress test lending appropriately to make sure that people don't just be able to assess lending today, but if rates rise in the future, they've got the capacity to meet those increased rises. So it falls under that gambit of responsible lending. The issue with that flat 7% is obviously over the last couple of years there's been quite a bit of variation in the market, so not all rates are the same. We've got quite a spread of rates, in fact, between owner-occupied principal and interest and investment interest only, and then depending on what your loan to valuation ratio is as well. So there's quite a spread of rates there, and that 7% flat rate probably didn't cover all situations, because in some cases now at 7%, effectively the buffer or margin being placed above that in some cases is close to 3.5%. Usually as a rule of thumb, there's usually the assessment's based on about 2%. So it's actually starting to distort the market. Obviously, the way it's been going at the moment, together with other approaches the banks have been taking, has really tightened the market and put a fair bit of restriction on credit, both for individuals and for businesses. So obviously they've revisited that to look at sort of freeing things up a little bit. But for how does that sort of operate? So at the moment, most lenders are actually using an assessment rate of around about 7.25, so even above what APRA have set. And some are a little bit higher, some a little bit lower, but that's kind of the ballpark. And for a typical household, that might sort of set their borrowing capacity at around about the 500,000 mark. If it was sort of a couple and two kids on about a combined income of about 100,000. So that's where they'd sit at the moment. If the assessment rate gets pulled back to around about 6.25, which is kind of where everyone's sort of ballparking it might head, then that would actually increase people's capacity up to around about 550 under that scenario. So that's an extra 50,000 that might mean that people can either look at getting a higher priced property if they're trying to get into the market, upgrade, might free up some money for renovations or home improvements, might also free up capacity for people who wanted to get into the investment market but were just coming up a bit short, might now put them in a position where they can go ahead. So I guess, that factor combined with potentially some expected rate cuts out of the RBA might start to free things up a little bit from a lending perspective, start to get the economy going and firing again. So, I guess we'll sit back and wait and see what the impact of this is going to be, but generally our expectation is this will probably get the market moving a little bit more and get a little bit more activity going. Anyway, once we know a bit more on the outcome of this, I'll update you accordingly. All right, thanks for your time today and have a great week.